Hey, Jason here. So, interest rates I read something the other day, I think it was interest rates have risen to the highest level in the last 4 or 5 years. People are freaking out. Does this mean inflation's coming? Does this mean I can't buy a house? Does this mean the stock market's going to crash? Does this mean a lot of things? What does it mean from kind of a finance and value investment perspective when interest rates rise? Doesn't mean anything. If you grew up in my kind of generation as a value investor and finance person, I started getting really serious about finance and value investing in about 2008. So we were already in the midst of the financial crisis. Interest rates had already cratered. So for the last 10 years or so, we've pretty much been in a low interest rate world, not only in the United States, but around the world. And a lot of countries, or even around the world, are to negative interest rates. I think Japan and Germany are two examples of countries that have negative interest rates, or had at one point negative interest rates. So we've lived in a low or negative interest rate world for the last 10 years. So people are freaking out about higher interest rates. And again, they're in the United States. I think the article I read said in the last 4 or 5 years, interest rates now, today, as of this recording, are the highest they've been in 4 or 5 years. So, from a finance and value investment perspective, what does that mean, if anything? Frankly, I don't really care about interest rates. I am not a bond investor. I have looked at bond investments in the past, mainly from bankrupt companies. Interest rates, to me, in the kind of the value investment realm, don't really have any bearing on my kind of very micro level look at an individual company. Do they become a factor if they are 8, 10, 12% like they were in the 70s? Yes, they become a factor then. But until then, to me, they don't really mean much. It means companies, because I don't invest in companies that have a lot of debt. If I were investing in companies that had a lot of debt or rely on refinancing their debt on a regular basis to kind of sustain their debt levels and sustain their operations, that is where you have a problem. Because as interest rates rise, if you're a large company and you have large debt levels and you have to refinance constantly and pretty much every year, with rising interest rates, you're going to have to pay ever higher and higher interest rates on that debt to service that debt. So what that means, you'll have higher interest charges, you'll have higher debt payments, you'll have less cash flow, you'll become more susceptible to a financial crisis and crash, because if the financial markets crash, or when the financial markets crash, you'll either won't be able to refinance, or you'll have to refinance on some crazy terms like companies did in the 2008 recession. So one of the things, that's one of the many reasons I don't look at companies with high debt, or those are some of the many reasons I don't look at companies with high debt. And just in general, it's a value investment kind of truism, I guess is probably the best term, is you want a giant margin of safety, and companies with large amount of debts don't have giant margins of safety in most cases. Another reason interest rates don't really bother me too much is, from a deep value investor perspective, is because I focus on generally sub $500 million companies. These companies aren't huge. They generally, again, I discard companies that have a lot of debt, and these companies can't get large amounts of debt anyways in most cases because they're so small. So, just like with what should you do when the stock market crashes, or when your stock crashes, if you are doing a good job and you stick to your processes and you keep looking and you keep an unemotional look at your portfolio, you will do a good job over time, even in high interest rate worlds. Again, and we're not even close to that. Historically, we're still near all-time lows in interest rates in the United States. So an interest rate rise, I think it was 4.5% on the 30-year mortgage, and I don't know what it's at on the 10-year T-bill. But for around 4.5% is historically nothing still. So, and the inflation numbers came out today. Again, I don't look at macro stuff hardly at all, but inflation is a big number because of all of the money not only the U.S. government, but governments around the world have printed since 2007, 2008. So at some point, inflation is going to happen. And I think the U.S. rate came in at 2.1%. They were expecting 2%, and people are, so, as you can tell, I don't really care too much about the interest rate. Again, as of right now, interest rates have pretty much zero factor on my investment decisions. But because of what I do and the companies I look at, the safety of the companies I look at, the low debt levels, the high cash levels, profitability, all those kind of things. So, what happens if interest rates get to 8%, 10%, 12% like they were in the 70s? I don't think they will, but let's say they go back to that number. Inflation gets out of control, interest rates go out of control, the entire economy collapses, or not collapses, but crashes because there's some kind of version of stagflation or massive inflation. If interest rates get to 8, 10, 12%, then hard assets like multifamily real estate, if you have a low interest rate, would be great. Bonds, I would actually probably start looking at more bonds if interest rates get that high. Not necessarily because I don't think I can't produce higher returns than 8, 10, 12%, but if you can lock in something for a 10 or 20 or 30 year period that's going to automatically give you 10, 12% like that, it's like a dividend. In another sense, it's pretty much a dividend, except you get it for 20, 30 years if you buy a solid company. Again, I don't look at bond investments in the past unless there's some kind of bankruptcy situation. So I'd have to kind of change my mindset when it comes to bond investing at that point. But again, would I invest less in stocks at that point? Probably. Would I look for more hard assets and bonds? Possibly. Yes. Would it still take me out of the market completely? No. Again, and a lot of this knowledge that I'm sharing with you right now about what I would do is just general knowledge, historical knowledge of what happened in the 70s and what people did in the 70s when interest rates went crazy, stuff like that. So, I mean, there's nothing really secret here. This is all just kind of common knowledge from reading about historical finance. I'm a big finance or history buff, especially when it comes to financial history. So I've read a lot about this kind of stuff before. And again, to me, I don't think interest rates will get that high. If they do, to me, it's still not that big of a deal. I just would switch my kind of asset classes a little bit and be less in the stock market, more into hard assets like multifamily real estate and bonds. But again, other than that, I mean, once you know how to value invest properly and you have the proper mindset, it doesn't really matter what you're investing in. You should do well if you can stick to your processes. What do I mean by that? Value investing, people think the stock market. If they think about value investing at all, they think about the stock market. Value investing mindset, and I talk about this a lot in the masterclass my team and I just finalized and built. And actually, the entire first week is actually about having the 6-week program is about having the proper value investing mindset and how this is so important. Because once you get this kind of foundational piece down, having the proper mindset, the proper outlook, the proper kind of base level knowledge, you can use the value investing mindset in anything. And again, if interest rates go crazy, I would just switch my asset classes because I know how to evaluate multifamily real estate, because I know how to evaluate bonds, because I know how to I know the financial history of crazy inflation in this country, mainly during the 70s. It wouldn't freak me out too much. Again, this is where being prepared and kind of having the mental models comes in. I talked about one of my other videos, the anchoring bias video. We're going to be starting to talk a little bit more about mindset and biases and mental models and stuff like that. So, again, interest rates. To me, I'm sure a lot of people will be freaking out, value investors, finance people, whatever. Will there be less investments from public companies if interest rates go higher? Probably, since they won't be able to buy cheap debt or acquire cheap debt. But again, I don't focus on companies that use debt anyways. I want free cash flow in the companies I am looking to invest in, whether they be public company stocks or private companies, or even multifamily real estate. I want them to produce cash flow, pretty much from day one, whether it's a public business, private business, or multifamily real estate. I want you to produce cash flow from day one, because cash flow gives you options. It does. If you have cash flow and significant cash flow and growing cash flow, you don't have to rely on debt. You have a strong balance sheet, or you should have a strong balance sheet, unless you lever up too much. You have the ability to acquire other assets or multi-family real estate buildings or public stocks or private businesses. You have the ability to rely on your operational free cash flow value, or the value your free cash flow your operations produce, to invest in your own business and grow your own business without having to rely on debt. You can buy back shares, you can pay a dividend, you can do cash, free cash, and cash gives you options. That's why I love companies that produce a lot of free cash flow. And that's again why interest rates won't bother me at all, because I don't invest in companies with a lot of debt, or that require a lot of debt, or have to refinance a lot of debt. I don't buy those kind of businesses, no matter what they are. So if you're in good businesses, good to great businesses that don't have solid balance sheets, high cash levels, low debt levels, or no debt, you'll be great. You'll do fine. Get away from watching the financial news. Get away from people like Jim Cramer, who are telling you to run. Get away from, the other day I saw when the market crashed 1,000 points, and I have a post about this that is going to release at some point here soon. But in the post, one of the articles I saw was 2 times in 1 week, something along the lines of 2 times in 1 week the stock market crashes. The 2 highest point falls in one day happened in the last week. The 2 highest. What they don't say, because they want to get you riled up and get your emotions going like crazy, is that on a percentage basis, those falls don't even, I think they were 4.2 and 4.5%, don't even crack the top 20 in percentage falls. So, again, if people are freaking out about interest rates, you probably should run from them. Or maybe they're a bond investor or some kind of other investor that relies on debt. I don't. So, to me, again, interest rates won't affect me too much. Even if they get to 8, 10, 12% range, it'll just make it harder to do things. It's not always going to be easy like it has been for the last 10 years. Actually, frankly, the low interest rate or no interest rate policy, negative interest rates, and the massive amount of printing money is ridiculous. It's a historical anomaly. So to rely on the last 8 to 10 years kind of in your thought processes is frankly silly. Doesn't make any sense, because it's a historical anomaly. It's pretty much never happened before on this scale. The massive amount of low interest rates and massive amount of money printing. So again, interest rates, in my opinion, shouldn't bother you too much. But I'd love to hear your comments below. I'd love to hear your thoughts below about if you have, if you agree, if you disagree. I'd love to hear why. I'd love to hear your thoughts, because as finance people and value investors, we have a lot of opinions, and frankly, I don't hear too many people talking about interest rates when it comes to value investing, probably because most of the value investors I talk to probably have a similar mindset to me. So I'd be interested to hear your mindset as well. See if I missed anything, see if I can add anything, see if you have a different thought process, see if you think I'm wrong, whatever. Let me know in the comments below. Like, share, love, and I will talk to you next time. Thanks.